Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Well, if you've been paying any attention today, you know exactly the economic data that hit this morning. U.S. retail sales broadly declining in January, indicating that consumers took a little breather after a strong holiday shopping season. So here's some numbers here. The value of retail purchases, unadjusted for inflation, decreased 0.8% from December. This after a downward revision to the prior month. This according to Commerce Department data earlier today. That drop, the biggest in nearly a year. Separate data showed U.S. factory production fell for the first time in 3 months in January. Following all of this, of course, is Michael McKee. He's International Economics and Policy Correspondent for Bloomberg News. He joins us right now from Washington, D.C., where he's at the National Association for Business Economics Conference. We're going to have more on that in just a minute. But first, Mike, I want to get to this data. The two reports that we got today, they pointed to a loss of momentum. But are they a sign that the economy is deteriorating?
I wouldn't use the word deteriorating. The economy is slowing. And we know, of course, that in January, Shonali went on vacation. So a lot of shopping didn't get done. But a lot of it is probably weather related. When you look at what happened across the country in January, a lot of snow, a lot of people stayed home, and car sales really suffered. That was about half of what we saw in the decline. Another major part was building materials and outdoor stores, things that would be affected by the weather. Now, there is some loss of momentum. There's no question about that. What we have to see is whether it comes back in this month in February, and that's what the Fed will be looking for. But it kind of offsets the CPI numbers, which is why I think you're seeing some rallying in equities today, because when the CPI came out, everybody wrote off the Fed cutting rates anytime sooner. But if the economy's slowing down, maybe they will. So the psychological game continues.
But let's draw the connection between the inflation data we got and the retail sales number. If inflation is indeed hotter than you expect, Mike, then wouldn't consumers start to slow down more into the year?
Well, there's two ways to consider this. One is that inflation is built into the prices. These are nominal numbers for retail sales. So if inflation is higher and you subtract it out to get the real figures, they're even worse than they looked. But I think the kind of inflation that we saw in many service industries, it was the primary reason that we saw the CPI go up. So it may not have had as much of an effect on retail sales, which are largely goods.
Okay, Mike, anything else in these two reports that we got earlier today that we need to make sure we understand here?
Well, one thing I would point out is that for the first time in about 9 months, we saw import prices rise, and that's even ex-petroleum. Petroleum prices pushed them up, but we also saw some goods prices go up in import prices. The Philadelphia Fed survey reported that their prices paid index went up. Not much, it's still low, but it went up. So with CPI and those two things, it may be a bit worrying that inflation might be picking up. And again, we just have to look at the retail sales numbers and say, maybe that's offsetting it somewhat. If the economy is slowing, then inflation should slow.
The question yet becomes, there's a lot of economic data still ahead, Mike. Tomorrow we get producer prices as well. What's the expectation?
The expectation is we get a little bit of inflation. Producer prices have run below the CPI significantly for quite some time. They're in the 1% range, 1 to 2% range on a year-over-year basis. So there's no reason to really think that they're going to go up significantly. If they do, we'll want to see in what categories, where might some inflation pressure come. Also tomorrow, we get the University of Michigan's consumer sentiment numbers, and that's always important to the Fed because they want to see what people's inflation expectations are. They've been moving down. They were significantly lower last month, and so if that continues, then the Fed is a little less worried about what the CPI might mean.
We got news, Mike, just in about the last hour that Fed Chair Jay Powell is going to be testifying before the House Financial Services Committee come March 6th. This from Punchbowl. Is this a surprise at all? What do we need to understand about him testifying in, less than a month?
this is his regularly scheduled, what we used to call Humphrey Hawkins testimony. He'll talk to the House Financial Services Committee one day, and then he'll talk to the Senate Banking Committee the next day. So it's not a surprise. It's a little bit later than usual, but we had been warned off the record that it wasn't probably going to come until March. What will be interesting is that gets us very close to the next Fed meeting on March 20th. So we have a lot of Fed speak between now and then that may not matter, because Wall Street's going to wait and see what Jay Powell has to say those days. And I bet you we get on Bloomberg radio and television big ratings on March 6th, at least, when he first starts to give his view of the economy and what policy might be going forward.
Yes, people want to watch him and people want to see him and hear what he has to say, of course. But we want to hear what's going on at the conference that you're at, Mike. I didn't know this thing started on Valentine's Day. What happened yesterday? What's going on today and tomorrow down in D.C.?
Well, yesterday was quite interesting. We had a presentation from Charlie Cook. He's the sort of guru of political analysts here in Washington, who suggested that the Biden administration is in trouble, not because people think that Donald Trump's a great guy, but because the economy's improvements haven't registered with the average voter yet. And that's got to turn around, or it could be an issue for Joe Biden. Then we heard from Michael Barr, who is the vice chairman for supervision at the Fed, who said that basically two things. He's with Jay Powell in, slowing down and waiting to see more data as far as monetary policy is concerned. But he also addressed all the concerns on Wall Street about NYCB and regional banks and their exposures to commercial real estate, suggesting that this was maybe a one-off because NYCB had bought Signature Bank's bad loans and that the system was under control. There was no real systemic danger, that the Fed was on top of it. That was kind of reinforced at a seminar today on commercial real estate, where basically the consensus was that we will see some businesses, some banks struggle with commercial real estate loans, but in general, the system isn't as bad as it has been portrayed. So far, so good. We also had Mario Draghi here today talking about globalization. And of course, he's always a big favorite of everyone.
Michael McKee, gonna have to leave it there. Don't have too much fun in Washington. I hope you come back tomorrow and we can see you here in the office. That's Michael McKee, International Economics and Policy Correspondent, joining us from the National Association for Business Economics Conference in Washington.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, here's some good news. At a mere 1.9%, the state of Maryland has the lowest unemployment rate in the entire country. And at more than $108,000 a year, it's got the highest median household income in the U.S. And then there's the not so good news. Maryland's economy is growing at a slower rate than the U.S. economy and its neighbors, Pennsylvania and Virginia, and labor force participation has not recovered to pre-pandemic levels. These figures are highlighted in a report last month from the Maryland State Comptroller's Office, the first report of its kind to be released. Let's get to the interview. We have with us this afternoon Maryland's Comptroller, Brooke Lierman. She joins us from our Washington, D.C. bureau. Comptroller, welcome. It's good to have you on the program this afternoon. As I mentioned, there are a lot of good numbers in the report, but there's also a lot of challenges here. Take your biggest challenge. Give us your biggest challenge. What in here concerns you the most?
Thank you so much, Tim. As you said, Maryland is doing so well in so many ways, but what we saw in this report through our numbers and analysis, as well as roundtables around the state, is that our labor force is constrained. We have a traditionally very high labor force participation rate in Maryland, and we still have a rate that is higher than the national average, but we haven't quite recovered from COVID. And so some of our economy is really constrained in the private sector growth. We're seeing good federal sector growth, but the private sector growth is constrained because of these labor force challenges. So, we are excited to release this report so that our policymakers, our governor, and others can really start to tackle these challenges, and our economy can continue to grow.
Now, Comptroller, what are the biggest challenges in the workforce, and who is bearing the brunt of the pain here?
So it's a good question. We are really fortunate as a state to have a robust a unique set of industries in the state, from federal to government to the port to unique biotech and cybersecurity and more all across the state, as well as numerous universities. What we saw in the data is that women have left the workforce at a higher rate in Maryland than nationally. So that's something that we're really focused on. We also have seen some health challenges over the years because of the opioid epidemic and continuing health concerns. And so we want to make sure that we're focusing on there as well. And then finally, I will say, our population growth is so important. When you're talking about labor force, it's about, the number of people both who live in Maryland and are participating. And we have seen lower numbers of growth in terms of population in the past few years since COVID. And so we want to make sure that there's a place for everyone in Maryland, that they can afford a home, that they can send their kids to our great public schools. And so that's where we're focusing as well.
Okay, Comptroller, I want to zero in on one issue that you mentioned. It's women leaving the workforce. I was really shocked to see the decline of child care centers in this report in the state of Maryland. We are seeing that you predict by 2027 there will be only 2,700 child care providers in the state, down from nearly 6,000 in 2018. I've got 2 little kids. Child care is front and center for my wife and I. How do you fix this in the state? Can you do that as Comptroller?
So, one of the things about my job that I love is that I can partner with our governor, with our General Assembly, our Speaker, Senate President. So as the Comptroller, I really serve as the elected CFO of the state of Maryland. And this report is about identifying some of those challenges so that our General Assembly and our governor have the information and can then formulate policies to tackle some of those challenges and seize opportunities. And this child care one is a huge one. I'm also a mom with 2 children. I understand the challenge of finding child care. And it is essential that we get it right? That we make sure that there's space in our economy for child care providers of all types, the private settings, but also the in-home care that many Marylanders and many folks who are below median income really rely on. And so that is certainly a focus of the General Assembly and the governor. He, in fact, mentioned it in his State of the Address this year. Do
you think it's something that the state can fix on its own, or do you need the federal government to help?
I think it's going to have to be a partnership. We will work with the federal government in terms of the Child Care Block Grant Program. Many years ago, we changed how we paid in Maryland to pay more. In fact, in the Office of the Comptroller, just this past year, we completely changed how, working with the Maryland State Department of Education, how we reimburse child care providers so that we could provide repayments and reimbursements in a much more timely fashion. So we're very focused on that child care piece to ensure that women have the opportunities that they want to work out of the home.
I want to switch gears a little bit here, and I want to talk about something that's on the top of a lot of people's minds right now. It is tax season. I want to think about your posturing versus some of the others around you. For example, Virginia Governor Glenn Youngkin has been of the side of saying the taxes are too high, yet at state and local levels and at the federal level, we're obviously facing massive constraints on budgets. How do you think about the tax equation for the folks who live in Maryland?
I think we can never enter into a race to the bottom. In Maryland, we're proud of our amazing public schools. I graduated from Maryland public schools. My 2 children are in public schools. We have amazing state parks. We have a robust healthcare system. And so I would caution us against, entering into any sort of race to the bottom as in terms of tax policy. I think what we have to focus on is making sure that Marylanders are getting the support that they need, that our businesses are able to grow and thrive here in the state of Maryland, and that we have the labor force available, a well-educated, a well-trained workforce available for employers so that they know that they can grow here over the long term.
Curious about the race to the bottom a little more. How do you compete with other states that are participating in that race to the bottom, particularly if you're trying to build a labor force?
Well, over the long term, what you see is, although Marylanders, if you look at the age brackets, Marylanders may be moving out of state when they're younger. When they're older, we actually see, the prime workforce age Maryland people moving into the state. And that's because of our schools. It's because of our opportunities. It's because of our housing stock. Those folks are finding their way to Maryland because of its reputation for being such a family supporting state. And so, that's where we have to focus on making sure then that those Marylanders can find the housing that they need, right? I think where I would focus is on making sure that the housing is available so that people can grow here, thrive here, and then retire here as well.
Comptroller, I want to talk about federal government employment because a relatively large portion of the state compared to other states works for the federal government. 5.7% of total Maryland employment compared to 1.9% of total employment nationally. Obviously, that's good for stability because these government jobs are stable, but I'm wondering what the downsides are of having so many government workers. Since those jobs are so stable, does it mean the working population doesn't necessarily have the same rate of people going and starting their own businesses, of entrepreneurship? Talk to us a little bit about that.
Sure. We haven't seen that in Maryland. We're very fortunate to have, I think, this high federal employment, although it sometimes does get a little dicey when the federal government might shut down. But, for the most part, it's a real boon to Maryland. And we're really excited to be welcoming the FBI headquarters to Maryland in the coming years. Because we have such a robust series of research universities in the state as well, including, of course, Johns Hopkins, the University of Maryland system, and more, Morgan State, we have a number of entrepreneurs and ideas and that are coming out of those universities. We see enormous tech transfer possibilities. We also are really fortunate to have a large number of immigrants in the state of Maryland, and we see a number of immigrants who are great entrepreneurs opening businesses in the state as well.
Comptroller, with the type of fighting, if you will, that we've been seeing coming out of Congress, do you share a concern with so many federal workers being in Maryland of a risk of a government shutdown?
Absolutely. It's for so many reasons, a government shutdown is irresponsible and challenging, certainly globally. But here in Maryland, it is as well. Those workers are having to go to work and they're not getting paid, or they're not working and they're not getting paid. It's incredibly challenging. Over the long term, they do get paid, and so the revenue does come in both to their households and to the state. The most challenging, one of the most challenging times that our economy has had relating to the federal government was actually after sequestration. We saw real challenges after that because of the long-term effect that sequestration had.
We only have about 30 seconds left, but you were a Democratic delegate back in 2016. I got to ask you a national question about the Democratic Party. Why do you think there haven't been more competition from within the Democratic Party against President Biden, given the challenges that he faces for re-election?
Look, President Biden and the Democrats in Congress have passed more important legislation in the past 2 years than I can remember in decades. I mean, from the IRA to the CHIPS Act to the infrastructure bill. I mean, the legislation that has come out is phenomenal, and it is game changing for not just the state of Maryland in the coming years, but really for our country. And so, I just think the progress that has been made under the Democrats, it can't be denied. And our economy has grown as well. And so I'm excited about what's happening.
Comptroller, thank you so much for joining us. That's Brooke Lierman, Maryland's Comptroller, joining us from Washington.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, U.S. retail sales broadly declined in January, indicating consumers took a breather after a strong holiday shopping season. The value of retail purchases, unadjusted for inflation, decreased 0.8% from December. This after a downward revision to the prior month. This according to Commerce Department data that we got earlier today. That drop was the biggest in nearly a year. For more on this and more when it comes to retail, let's bring in Anjee Solanki, National Director of U.S. Retail at Colliers. She joins us from San Francisco. Good to have you back on the program. I want to start with today's data, but then I want to move beyond that and get to what you're seeing in your work in terms of AI, in terms of efficiencies, and really what we're seeing in the future of retail. But were these numbers at all a surprise to you that we got a little earlier today? What are you seeing in your work?
Yeah, I mean, if we look at the numbers, it's a reasonable start to 2024. It's just, our January numbers, it's not fatal. If we really look at core retail in terms of increase, it was about 2.8%. So that's pretty healthy. And if we really look at back 2 to 3 years, what we've seen from retailers is really that operational efficiency and how they're looking forward in terms of utilizing different tools and platforms to increase their efficiencies and margins going forward.
A big question that a lot of investors have too is if they're using money to invest in things like AI to increase operational efficiency, how much of that money is turned around and used to pay employees, for example? Do you need to raise prices for consumers in order to invest more? How does the equation work at the end of the day?
Yeah, it's really dependent upon each of the retailers. So each retailer will have a slightly different business model. But what we have seen, or are monitoring, I should say, closely, is using AI from an operational efficiency perspective can be a savings of 60 to 70%. Then what happens is we start to layer on, and I'll use grocery as the category or segment as the example, is that you then can offer additional products through a private label system. So when you do that, you're actually seeing a better margin increase. So operational efficiencies, margin increases allows that retailer to actually provide, to your point earlier, better wages.
What are the inputs that give them the data that allow them to make these decisions, to have these efficiencies?
I mean, if you stop and think about AI, right, we're kind of in its infancy as it relates to retail. There's a lot of discussion around it. There's still adoption around this. We're seeing AI used definitely from a distribution perspective, so the supply chain, but also we're able to take AI a step further because we've been harvesting, or I should say retailers have been harvesting POS or point of sale data through transactions, whether it's online or offline in the store. So when they're collecting that data, they have the ability to start utilizing the AI overlay to start to find themes around personal customization, areas of where they're seeing a certain product sell far faster than a different product. So that is helping from an efficiency perspective.
How do you think that the year is going to play out? The thing that's really top of mind right now for investors is that data we saw from retail sales just this morning being worse than expected. If the consumer starts to become more strapped this year, what are the things that many retailers are not really thinking about at this moment to prepare for that?
It's a great question. So there is a little bit of what I'm calling the, credit card hangover from December. There was quite a bit of spend in December, so people are being much more cautious. We have definitely seen big ticket items, look at it, a bit of a decrease in terms of sales and spend. But where we have seen a shift and increase in spend has been actually in the restaurant and bar scene. So it's the allocation of funds. Now, looking forward into 2024, we're going to be very, call it optimistically cautious. I know we've used that word quite a bit, but I think last year was one where we were really focused in monitoring every single movement within retail. This year, I think there's more of a consciousness around how people are spending and where they're spending, but it's going to be very value driven. And I don't see that changing throughout the year.
Where specifically are you seeing weakness? And dare I ask if you're seeing any recession right now?
Recession, no. We're not definitely forecasting recession as of today. What I would suggest is that we're really seeing in terms of, a decline in sales as electronics. We're going to continue to see some softness in, kind of that tech device sector. But from a F&B perspective, I think we're still bullish in that sector. We actually surveyed over 500 retail professionals within our organization to say, where are you seeing across the U.S. in your respective local markets the most movement from a lease transaction perspective? And it's definitely in the restaurant space.
Now, another thing we talk about a lot over here at Bloomberg is the cost of real estate right now in retail space. And there are a lot of retailers that really expect to expand a physical footprint. How costly is that expansion plan?
It is market driven. I think, what we're seeing, some of the challenges is it goes back to construction cost, workforce, as well as when you look at where we are from an occupancy perspective in the more urban suburban markets and secondary markets, rents have continued to climb. And those are going to be, at some point, there has to be a tipping point, right? Because there's only so much a store can generate in terms of sales. So we have to work collectively, landlords and retailers, to make it much more a partnership so that it is sustainable and there isn't this flip. And we're starting to see some struggle or challenges with higher rents.
What about in terms of, we've talked a lot about real estate on this program over the last few weeks. And one thing we talked about earlier this week with the co-CEOs of the design and planning firm Gensler is repurposing office space that isn't being used right now, repurposing that to housing. I'm wondering what you're seeing on the retail side right now and the way that you're seeing retail being repurposed. Can you offer any thoughts there about what you're seeing and if you're starting to see that being converted to different uses?
So what we're seeing in terms of retail converting to, it's retail converting to other types of uses. So you're seeing this a lot in the mall sector. So you're starting to see some of the larger boxes where you have an opportunity to upgrade in terms of the overall mix of types of products, or I should say uses within the project. So you're starting to see some concepts such as hotels coming in. So you're starting to see hotel operators coming in. You're also starting to see, and these are when I consider malls, these are, malls that may have slightly higher vacancy, maybe, they have a 75 to 80% vacancy versus the class AAA malls. And so we're seeing hospitality, we're also seeing healthcare. So large healthcare organizations see advantages and or benefits, right, as it relates to if I can create a convenience to my end user, patients in this situation, and even the doctors and the staff, etc. You're allowing these people to come into a node because typically retail malls are in accessible areas. They have great accessibility in and out, ample parking, and then you're also providing other benefits where if there's shopping opportunities, food opportunities. So we are seeing that occur. Interesting thing that you said, and we just published this, which is kind of this retail office interdependency and that relationship more in the urban markets. What we're now seeing is this new trend, and that trend is with small businesses. And I'm really excited about that because you're starting to see small businesses pop up more and more. And I think landlords are giving them an opportunity to take a vacant space and really activate that and warm it up for.
That's interesting to hear. Yeah, that's interesting to hear, especially because in terms of new jobs that are created, small businesses account for a huge portion of those. Hey, Anjee, we got to leave it there. Anjee Solanki is National Director of U.S. Retail at the real estate firm Colliers. She joins us from San Francisco.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It drives me crazy.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Well, just about 18 minutes to go until the close of trading here. We just heard an update from Charlie Pellet and Bill Maloney that we're seeing some late day buying. The S&P 500 off its session highs, but still up 0.5 percentage point. The NASDAQ up more than 0.1%, while the Dow up 0.8%. Let's get our drive to the close with Megan Horneman, Chief Investment Officer at Verdence Capital Advisors. She joins us from Hunt Valley, Maryland. Megan, good to see you. How are you?
I'm great. How are you?
We're doing well, thanks. Trying to make sense of the kind of conflicting data that we got this week and last week that shows that inflation came in a little hotter than expected, retail sales coming in a little lighter than expected, all on the heels of that jobs report that came out last Friday that showed that hiring in January was robust. What's on your mind?
Right now, I'm a little bit concerned about the inflation. I'm not so much concerned about what's going on with the retail sales. Again, it was a disappointing January. Don't forget, we had a pretty big jump in December. So this could be some give back. There's some nuances with the seasonality as well. But the inflation is the bigger concern. And the reason that's concerning me is we've warned for a long time that inflation can be a bumpy road down. It's not a straight line down. The Fed's made it pretty clear that they're more concerned about inflation than they are about the economy. So there's a lot of people and expectations for these rate cuts this year, and I'm afraid that might be a little optimistic given that inflation data that we saw.
Even still optimistic?
Yeah, you're still looking, instead of 7 rate cuts, I mean, I don't even know where that came from, 7 rate cuts to now maybe down to 4 rate cuts. But if we get some more of this volatility and inflation, the Fed could remain on hold this entire year.
Well, that's what I was thinking a lot about. What if we get no rate cuts? And indeed, what would it take to see another rate hike? I mean, how much risk is there of reacceleration of inflation at this rate?
I think there's a risk. I'm not ready to say that there's a chance that they could have to hike again this year, but there is a risk. We haven't seen the full effects of what's going on in the Red Sea. We know that shipping costs, these are all skyrocketing. We'll get some more information from the producer side. If you look at the ISM services index that we got for January, that prices paid component jumped up to 65. And that was a pretty big jump there. So these are things that are showing us that sticky inflation the Fed has warned us about. The service side, housing, wages, this is still a problem, and we may not be able to say we're completely out of the woods there.
And how lagged is a lot of this data? If you think about, for example, one thing that struck me this week was the mortgage rate climbing the most you've seen in 2 months here. And interestingly, that came before we saw the interest rate jumps this week, right? We saw the yield rise meaningfully this week in the 2-year and the 10-year. So how much more pain is there in terms of the impact of higher rates? And kind of how cyclical is this problem at this point?
Yeah, it takes a while for the full effects of the Fed rate hikes to be felt in the economy. And what you're seeing is this dispersion where the Fed has done such an aggressive rate hiking cycle. But if you look at things like financial conditions, because of the rise in equities, because of low volatility, because credit spreads are so tight, you're actually seeing financial conditions, some of these indices that are out there, financial conditions are the easiest they've been since before the Fed started raising rates. That's a problem. The Fed has said, I think the problem the Fed did is they got dovish in December, and that sparked kind of a resurgence from economic data, and that's very easy to reignite inflation. And then you put on top of that the fact that we have these issues in the Red Sea. This is a concern for inflation. Don't ever take 1 month of anything for a trend here. We're going to look at some of the underlying data, some leading indicators, and we'll see if this continues month after month to get a better idea. But it is a risk that we could see inflation kind of stall here with the progress we've made.
So what are you seeing in terms of your own predictions for the year, Megan? Are you thinking that, okay, this is just a blip, this CPI figure, or is the Fed on track to actually successfully bring inflation to its 2% target?
I think that they're on track to get it to their 2% target, but not as quickly as most anticipate. I think that it's going to be really difficult to get from where we are now down to that 2%. I'm not as optimistic that we'll see that this year. I think that may be a 2025 story. One of our themes for this year was that the Fed was walking a very fine line and that reinflation was a risk. We saw that coming into the year. They were so dovish in December. Equity markets took off. You saw spending from consumers take off. You saw consumer confidence pick up again. Those were things that concerned us about reinflation being an issue. And then you have to look at what are the markets pricing in? If the markets weren't sitting at record highs, then we might say, hey, they're not. They're being a little bit more realistic of where we are and what the Fed can and can't do. But the market just continues to notch these record highs this year, and it's disregarding a lot of these signs in the economy.
So what do you think investors are ignoring now as they engage in markets? You look at a lot of these indices near all-time highs and a lot of exuberance in certain parts of the market. After everything you've said about kind of the miscalculation in the market about rate cuts and some concerning economic data that we're seeing, how should investors be thinking about positioning?
So what we're doing is, first thing is hold extra cash. We are, as I mentioned, the Fed may be on hold for longer than most are pricing in the market. So holding extra cash isn't at the end of the world at this point. You're getting 5% on your cash levels. So holding extra cash and being able to take chances when the volatility in the market arises, which we expect. The other thing is, we just did this in the beginning of the year. Look at your portfolios. Look at where you should be, your asset allocation is. Has it deviated? It definitely has deviated in some of those areas like growth when you're looking at your portfolio. So rebalance where is necessary. That's something that is important to do. We're being patient. We're waiting for opportunities in the market. There will be opportunities. I just think right now the market's looking a little bit frothy, a little bit too optimistic, and pricing in this perfect landing, perfect inflation story for 2024.
Hey, just 40 seconds left. What kind of opportunities are you talking about here? Are you talking about opportunities of like a 1.5% pullback or something more significant?
Something more significant on the large cap space for sure. But there is opportunities, we think, in the small and mid cap space because they're pricing in, I think, of a lot of the downside risks. So if you can withstand the volatility that can arise as the economy continues to weaken, I think that over the long run, you'll be rewarded in that small and mid cap space.
Hey, Megan, love it when you join us. Really do appreciate you taking the time this afternoon. That's Megan Horneman, Chief Investment Officer at Verdence Capital Advisors, joining us from Hunt Valley, Maryland.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.